Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan talks with best-selling author William Cohan, who has a new book out on GE.
And for our opening rant, the FTX debacle gets even crazier.
And remember, you can email us at feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Well, just when you thought it might be over, FTX got a little crazier this week. Did you see the Vox article with all the direct messages between Sam Bankman-Fried and his friend, who just happens to be a Vox reporter? I mean,
yeah, that story, as often is the case with these, it's worse than you initially thought, I would say.
Yeah, I would say it's worse than we initially thought. Like, I mean, the list of creditors, there's literally, I think it's like a million creditors. And, you know, the list of firms on there is just like, you never would have thought in your life. I never would have thought in my life that like Dan Loeb, Third Point Capital would have invested in this, or like Paul Tudor Jones. I mean, I was shocked at the list of creditors. But
yeah, it spread far and wide. I mean, BlackRock was in there. It's, you know, and I don't think BlackRock's going to be hurt too much by this, but still, it shows you the amount of different institutions that were wrapped up in this. And Sam Bankman-Fried's kind of con, we can call it, right?
Right. I think we can start calling it. Like, a lot of them are not a surprise, you know. Any venture capital or even like private equity or whatever. Okay, fine. You know, I get it. But I don't know. And even like Ontario Teachers Pension, I mean, the pension funds, they're always the last one into the worst ideas at the worst moment, you know?
Right. That thought did kind of pop up in my mind about, you know, when crypto was really, and Bitcoin was really taking off this last cycle, you know, this last boom cycle, you had the institutions saying, oh, we're getting demand for crypto products from, you know, pension funds and people who want to get in on this. And, you know, that was never a great idea for these reasons, you know, but yeah, this story is quite something. I was listening to a sports talk radio show this morning from New York, and they were talking about it. They were talking about Elon Musk and Twitter and FTX because, you know, one of FTX had advertisements on all the baseball umpires' jerseys, basically. So whenever you would watch a baseball game, you'd see this big FTX symbol, and nobody knew what it was in sports. Like, really, you know, they had a Super Bowl ad, but in the sports world, you know, if you're watching a baseball game and you see FTX, and the comment was, nobody knows what it is, and that's the story here. Like, nobody really knew what was going on.
Right. Tom Brady had $600 million in it. He knew, and he didn't know what was going on.
Right. Yeah.
I mean, the amount of money, when I read that headline, I was like, no. I mean, they just went kind of all in, he and his, you know, now former wife. It makes you wonder, like, what's left in the divorce, you know? Whatever. It's crazy. But the thing that got me was he had this conversation over direct message on Twitter with this Vox reporter who he says is a friend. He thought it was private. It would never be published, which is really dumb. You know, it's more bad judgment. That's what I'm seeing all through this thing, you know? And the whole bit with lending, I thought the way it was represented in the Wall Street Journal, they lent $10 billion of customer deposits to their affiliated crypto trading firm, Alameda Research. But what he represents in this, series of tweets, like at one point he implies that, he says, it looks like people wired $8 billion to Alameda, and oh God, we basically forgot about the stub account that corresponded to that, and so it was never delivered to FTX. And he says, FTX doesn't have a bank account. I guess people can wire to Alameda's to get money onto FTX. In other words, like, people thought they were wiring money to FTX and it was going to Alameda, and their controls were so bad and they were so lax in paying attention to anything that he wants me to believe that they didn't notice that there was 8 billion that was supposed to go to FTX accounts, and it was just kind of stuck at Alameda because whatever, some dumb reason. I don't know. I don't know if I believe it. I mean, do we really believe it? I don't know.
Yeah, I mean, I guess we have to know a little bit more about him as a person to know whether he was just inept or whether this was seriously fraudulent. I mean, some of these texts, he says he wasn't, or messages, he says he didn't want to do sketchy stuff, or he didn't mean to. So, I mean, he's also talking to a friend who's a reporter here, so you got to know the context. So, yeah, this one will go down and be remembered for a while.
Yeah, and I don't know. He just the things that he dismisses, like, he's talking about how he thought Alameda had enough collateral to reasonably cover, any shortfall or whatever the difference was between the two companies. And then the reporter goes, well, I get how you could have gotten away with it, but I guess that seems sketchy, even if you get away with it. And then SBF says, it was never the intention. Sometimes life creeps up on you. 8 billion just creeped up on us. I mean,
yeah, something's going on with this guy.
To be young, huh?
Yeah, I mean, there's a lot going on here. But the part that cracked me up was then he says, if you just give me 2 weeks, I would have been able to fix it. And it's like,
I know,
if I had a nickel for every time, I made a mistake, I would, I'd be rich. So
I know. Well, it's only 8 billion that he has to come up with in 2 weeks, right? How hard could that be?
Right. It just tells you what he thought he could get away with too, even as cryptos are kind of imploding. So
kind of.
Yeah, kind of. Sorry, I throw in those words too often. But.
Right, kind of. And crypto's imploding, and like Cathie Wood is buying the dip, man. She bought, for her finance innovation ETF, she bought November 16th, she bought a bunch of Coinbase and some Silvergate Capital. And Silvergate, I'm not sure really what they do. I know it's a bank that has this crypto, digital asset network or something. But with Coinbase, I mean, like, their bonds trade at like 50 something. It's distressed. It's 1,000 points over treasuries. It's insane. And the market cap is like 11 billion of the stock. And they made money once in 2021 at the height of the biggest crypto frenzy, that you could ever imagine. They didn't make money before that. They've lost $1 billion after it. And they're firing employees, and their bonds are at 50 distressed levels. I mean, I don't know. I guess she puts other people's money where her mouth is. You got to give her that.
Yeah, she is not giving up. I would say that on her original plans for this year, it seems like. But this also reminds me of, and we can go back to Cathie Wood if you want, but this also reminds me, which domino is going to be the next one to fall here in crypto?
Yes.
I mean, this was 2 months ago. We were talking about the Terra ecosystem kind of imploding. Now we're talking about FTX, one of the largest crypto exchanges. Coinbase is the next, could be, if things are going to get worse, you would think that they will be on the list of companies that will be amongst the fallen. And this all wraps me up. This is something I wanted to say last week too. Reminds me of something our Crypto Capital editor Eric Wade has been saying for a while. Like in advance of this, was you have to. Like, a lot of people are getting caught up in the bankruptcies of these companies now, like individuals. I'm saying, because they have their cryptos just sitting in these exchanges, these centralized exchanges, Eric calls them. So if you really want to have control of your crypto, you need to have them in these decentralized platforms and really own them yourself, whether that's the cold storage or whether that's certain apps that it's yours, nobody else is controlling it. That is the main takeaway from all of this for me. is all the
Yes.
people that don't know that and are just have, $1,000 or $2,000 sitting in Coinbase now. I would I would make sure you own your cryptos, not the other way around, that somebody owns them.
That's a great point. What was the first thing? Like, one of the first things we heard from the FTX story was, they shut down the withdrawals. People withdrew $5 billion worth of stuff from their accounts, and they shut down the withdrawals. So then your assets get trapped.
Then you're stuck.
That's actually
in
great
this,
advice. And
you're stuck in this bankruptcy, process, and who knows what you end up with. That's out of your hands at that point.
Yep. Yeah. And what's his name? SBF was saying in the Twitter conversation that he regretted declaring Chapter 11, and if not, the customers would have been whole in another month or something, and the withdrawals would have opened up. I mean, of course, if he raised $8 billion. I mean,
right. Yeah, this is all ifs, and it's crazy. Celsius went bankrupt, I don't know how many months ago, and they're still going through the whole bankruptcy process, and I don't think anybody's gotten anything back yet. That was another big crypto lending platform where you didn't have any idea where they're offering these huge yields, which raises eyebrows, and what's really going on here. They're basically just lending out your cryptos, was just my point about, if you have them yourself, that's not possible. So
yeah, the most benign take that I've seen so far, benign, reasonable take, was Matt Levine from Bloomberg. He kind of, the way he framed it was like, well, I don't. He's like, I don't know if this is a fraud or not, but it sure is exactly what you would expect from, a bunch of college bros who just kind of get together and share an apartment and do something cool like that. They only want to do the cool stuff. They didn't want to do any of the boring compliance and accounting and all that stuff. And none of that got done, and the whole thing melted down. So who knows? Maybe it really is, as quote innocent, I have innocent in air quotes here, as that, but ugh.
Yeah, it could
Anyway.
be. But either way, I already saw that they're getting called before the Financial Services Committee to talk about all this, which will then bring up the whole regulation piece in Congress, which, this was not where I don't think Satoshi Nakamoto had in mind way back in the day when he wanted a peer-to-peer platform with no government interference. It became,
I know.
It did not, it went away from that, and we're seeing, the fallout from that.
Yeah.
Right now.
Yeah, I have questions about that too. We need to get Eric Wade back on the show or something, or maybe I need to talk to him offline and report a few facts or whatever. But
yeah,
it just seems like exchanges are centralized platforms, and the whole point of it was peer-to-peer, decentralized commerce that went around all those financial institutions that had to be trusted. Right? It was called the trustless or no trust system. And I'm like, well, people had to trust FTX, and they had to trust Celsius, and they had to trust, whoever else, all the rest of them. They have to trust Coinbase. They have to trust Binance. And yeah, I agree. I don't think that's what Satoshi had in mind.
I would love for Satoshi to talk, by the way. If this message gets to Satoshi, please.
Yeah.
Show yourself.
Yeah.
Yeah.
Absolutely.
Yeah.
Explain yourself and explain what you really had in mind, because it couldn't have been this, right?
Yeah, maybe that's why he went. I mean, that's why he got out of it, or went dark. He didn't want to. He saw where things were headed way back when.
Yeah, that's exactly right. I mean, he saw what happened during the financial crisis, how dependent the world was on enormous centralized institutions, like governments and central banks, not just banks. And so he came out with this thing. It's in the white paper, I think, that discussion, and and now here, his thing got hijacked too. Like I forget who it was, said politics hijacks everything, and I would say politics centralizes everything, and crypto is no different. But one day, who knows? Maybe one day this will all get worked out. And I wonder what that day will look like. And I hope I live to see it, frankly. I mean, I hope this all does work. I hope Bitcoin or Ethereum or whichever ones are going to survive and be something, start to get on with it soon, because I would like to see it.
Yeah, me too. I mean, we can talk all day about the problems that central banks cause, and so it would be nice to have some kind of alternative to that. And I'd still, given all of this, this calls into question a lot about cryptos, obviously, but the blockchain technology has not changed. All the stuff going on in these Ethereum and different networks that are tied to actual products or actual values, that stuff, of course, I think still has potential. This got messy very quickly with leverage and trading and greed and everything. So it's a stain on crypto. Like, this will be in the Wikipedia page and on cryptos for forever, as long as Wikipedia is around. This was the crisis that whatever. But again, like we said last week, there was also specific circumstances here with the CEO of Binance and FTX and all of that. So people won't remember that, though. This was a sham, and don't trust anybody again. So, which is a shame, because there is a lot of promise there.
Yeah, but if it works out, if Bitcoin becomes the Amazon.com of crypto, maybe we'll let the crisis fade, as we've generally let the .com crisis fade. Like, we don't really remember. I mean, I guess I remember peapodgrocer.com, women.com, maybe a couple of others that we could name that were just horrible business ideas and failed very quickly and rose spectacularly and crashed and all that. But we got past it, right? Of course, we got past it because there was a new bubble right after it.
Well, no, but that's a great point. The internet's still around, right? After the .com bubble, 20 years later. So, and evolving still.
Yeah, and some of the things that went on at that time, Amazon obviously became huge. Search, Yahoo didn't, it was the big search engine for a little while, but then Google came along and took over. So search became a very, very big deal. Like, we always sort of knew that. And, other things, of course. And then we finally, the promise of streaming came to fruition. And cool things happened. And I can't, my imagination is just not good enough to project forward and figure out the few cool things that are going to come out or could come out of Bitcoin. But I do hope, and I'll say this just one more time, I do hope that it works and that we live to see it.
Yeah, me too.
Yeah. So, speaking of scandals and, wonderful things that crashed and burned, I had occasion to talk with William Cohan about his new book about General Electric, which is an incredible, it's like a mammoth book. He does these in-depth studies where he talks to everybody he can who is involved. He talked to Jack Welch, he met him and talked with him and just did his usual thorough treatment. And we talked about that and a few other things when we got together in Boston recently. And I really want everybody to listen to this and pay attention to it, because the lessons in it, we're not necessarily talking about stuff that's going on right now, but the lessons in there, you'll be nodding your head through the whole thing because of everything that is happening right now. So it's kind of a perfect interview for you to hear right at this time in our history. So let's talk with William Cohan. Let's do it right now. Hey, Dan here. Before we kick things off, you've got to see this. A Connecticut man has been warning the public, quote, "Get your money out of U.S. banks immediately. A historic financial reset in 2023 could cause a run on the banks unlike anything in our nation's history," he says. His warning has already reached 8.4 million Americans and 30 TV networks, and yet few people realize this could actually happen on U.S. soil, or what a sizable impact it could have on your wealth, especially if you have large amounts of cash in the bank right now. Normally, I might ignore all this, But it turns out he's a Wall Street legend whose work predicted the COVID crash, the 2022 crash, the 20 best stocks of 2022, and more. Today, he's urging you to move your money into a new vehicle 50 years in the making. He's even posting a free recommendation, which you can access at moveyourcash2023.com. His work pointed to a more than 10,000 gain back in 2020, so don't miss this. A new vehicle outside the banking system could massively boost your wealth. You can get the details today at moveyourcash2023.com. Again, that's moveyourcash2023.com. William Cohan, welcome to the show.
Thank you, Dan. It's great to be here.
Yeah, it's good to have you back on the show. Last time, just for our listeners, we talked pretty much exclusively. We spent most of the conversation on your book, The Last Tycoon, about Lazard, which was a book I loved. It was just like, it was like, remind me of the TV show Dallas. I mean, the drama and the melodrama was pretty intense. Great story. And now I've got here your newest book in front of me, which I have not read because it just came out, Power Failure, The Rise and Fall of an American Icon, all about GE.
Right.
Yeah.
And it's actually not even out yet. It's not out till November 15th. So These are special copies that we made available to you, Dan, and the people at this conference.
Oh, that's great. Well, thank you for that. I thought I had ordered. I thought it was, hadn't come out yet, and then I saw it over there, and I was like, "What?" So I'll have to.
Special friends of Rick, we made, and as I was saying to you, I don't even have my copies yet, so it's nice to see it over there. It's been a long time coming.
Yeah, funny you should mention that because I have on my shelf at home. I just started House of Cards, your book about the financial crisis. And what else do I have? I have the book about Goldman.
Called Money and Power.
Money and Power, yes. And Four Friends.
Yes, about 4 of my friends from high school and what happened to them in their lives.
Yes.
It sounds like you're only missing the story called The Price of Silence about the Duke Lacrosse scandal.
Yes, I am missing that.
Another insane story.
Yeah, I bet. Maybe we can talk about some of those. But I had a question that I was thinking about this morning, and I'm glad I just remembered it. I wonder if you wouldn't mind talking for maybe just a few minutes about your process, because I'm serious. These books are epic. They are. I mean, the thing, it's thick. There's a lot here, but there are these epic tales that are just so deeply researched. And as I read them, I was reading through, just the beginning. I just started House of Cards literally like a day ago. And I was reading through the whole bit about, Bear Stearns is really the story that starts that off. And I had the feeling like I was in the room with all these people. I backed off from that. I thought, does he know all these people? How did he get all this conversation?
Well, I mean, part of my job is to not only research what I can from documents or memos or from the public information or from previous journalism along the way, but part of it, my job also, my self-described job is to interview as many of the people who are actually involved in what I'm writing about as possible. And knock wood, Dan, I've been blessed along the way with people pretty much cooperating with me.
That's lucky.
It's very lucky because these are all sort of contemporary stories that are happening in real time, whether it was the collapse of Bear Stearns or the rise and fall of GE. Obviously is an ongoing story, and except that we know the ending now, and it's happening in 2023 and 2024 when they split the company up. But I was fortunate enough, in this case, at least, to spend a lot of time with Jack Welch before he passed away, and with Jeff Immelt, the CEO who followed him, and many of the executives at GE were very generous to me with their time. And I always find it, a bit of a miracle that happens. And that's happened in every one of my books. So with the one exception, well, not really an exception, but a different kind of dynamic with Four Friends, which was a book about 4 of my friends from high school and what happened to them. Unfortunately, they all 4 died young and tragically, so I couldn't speak to them, obviously, but I spoke to their, wives and girlfriends and friends, and, just sort of talked to everybody I could about their lives, after we left each other, at 18 years old, which was a long time ago. And so, I've had, again, a lot of cooperation all along the way, and it's truly a blessing. But part of the, maybe the analogy I might make, or the metaphor would be something like, I love to hike, and I've been a lot of places hiking, and you get up to this, incredible meadow, or you get up to some sort of rocky terrain or mountainous terrain, and the expanse is gargantuan, right? I mean, it's just huge. Like I hiked up to Everest Base Camp, the base camp of Mount Everest once after 3 weeks, and the vista is just huge.
What's that, like 18,000 feet or something?
Yes. Wow. But there's a path through it. So you collect all this information about GE, or about Lazard, or about the collapse of Bear Stearns, or about Goldman Sachs, or about the Duke lacrosse scandal, or even about your friends, and it's my job as a writer to carve a path through all of this information for the reader. I need to know pretty much everything, but the reader doesn't need to have everything, because that would be a book that's even bigger than this book. So that wouldn't do anybody any good. So my job as the writer is to carve that path through this incredibly beautiful terrain for the readers. And, things that really struck me as important are what I include, and things that, aren't necessarily that important or that central to the narrative, have to be discarded. But, I know about them, and I can talk about them. And if people have questions, I can answer them. But I tried to create, in this book and in every book, sort of the best possible narrative I could for my readers, because, I like books like this. I like to read books like this. And some people say, well, it's so long, or it's, there's so much of it. Well, my feeling is, if I've got a book that I'm really enjoying about a topic that I really like, more is better, man. Yeah, that's great. Exactly. Lay it on me. Why? One of my favorite books was, Bad Blood, about the Theranos situation, which I loved. But I also felt that it was truncated. Like I could have had more. I mean, I'm sure, it was a bestseller. And
you know how publishers are about that.
Yes, I do. And my publishers have been nice to me and let me, have my space. Not as much as even I wanted, but enough. We reached a nice compromise.
That's really cool. I went ahead and asked you to speak about this. I'm going to, rather than keep my agenda secret, which I feel like I should do, I'm just going to let you in. I was hoping that there's an investment analogy here, because we spend all our time doing research on stocks, bonds, ETFs, et cetera, et cetera. That's what we provide for our subscribers, and there's a process. And you are similarly, collecting all the choices together and cutting a path through the market.
I'm like this, research analyst on steroids. I mean, that's really what I am. I do, part of it is, okay, there's a dead body on the floor. How did it get there? And I'm doing the autopsy. I'm doing a corporate autopsy. How did GE go from being the most valuable, most respected company in the world to irrelevant, being broken up, being, a fraction of both what it was worth and how, the respect that people had for it? Or Bear Stearns. There's literally a dead company sitting there. It dissolved in a week. How did that happen? Yeah. I mean, and I used to work on Wall Street, so the idea that Bear Stearns would disappear is like monumental. How did that happen and why? So I'm like a forensic accountant almost, but I'm also, so I want to understand the numbers and the reasons and the nuances, and was it, because of the way they financed themselves, or they took too much risk, or they made bad decisions. But I also want to tell a great story. So I feel like, I spent 17 years as an M&A banker on Wall Street, as we discussed before. Mm-hmm. And I feel like, okay, there aren't many people who are writers who did that. So I really understand business. I really understand how, and the business of America is business, right? As was once said, I think, by the head of General Motors. But, my job, as I've figured out after all these years, is to sort of translate those big events or those incredible stories of companies into a narrative that people can read and enjoy, because there's these incredible characters doing these wild things that you can only imagine. Truth is stranger than fiction, as we know. Oh, yeah. And so, just going out and getting that story and bringing it back for people and putting it between those two covers and getting to answers. What the hell happened to GE? What the hell happened to Bear Stearns? How did Goldman Sachs survive the financial crisis when nobody else did? What the hell is Lazard all about, this mysterious place? Or what happened in the Duke lacrosse scandal, really, as opposed to what people think happened?
Right.
That's my job.
That sounds like a pretty good gig.
And I'm my own boss, and I have my own equity in these projects, which I really like too.
That's great. As I was reading the beginning of House of Cards, you reminded me of that fairly famous quote at this point by Jim Cramer about the franchise being strong at Bear Stearns. And he made a very similar comment recently about UBS, I think it was. And it echoed in my head. I thought, oh yeah, you reminded me of it because you put it in the book. I thought, and I really had a moment there where I sat back and I was thinking about a financial institution as a franchise, right? As a brand. And I want you to tell me if you agree with this, Bill, because I came up with a truism. I was like, something, leverage trumps franchise, leverage trumps brand. And in our system, all financial institutions are levered. A really well-capitalized bank is like the 14% tier one capital, right?
That's sound corporate finance.
Right.
Policy is to have a fairly large amount of debt.
Yeah.
But not too much.
Right. Not too much.
Not too much. Everything in moderation, as my mother used to say.
So the definition of too much mostly is okay, but every now and then, the cycle changes and too much gets, it's a lot different than it was,
Right, but the job of the CEO, the job of the CFO, the job of the board is to, anticipate changes in the economic environment and to make sure that the capital structure of the corporation is prudent to make it through those times. And if you're not doing your job, and frankly, I don't think the board of GE and Jeff Immelt did their jobs on that score, because during the financial crisis, GE almost went down the tubes, although nobody realizes it, which is an important story I tell in the book.
Right. It's almost unfair of me. This book is another epic tale of yours, but, we should talk about some of what's in it.
Well, talk about what you want.
Yeah.
Yeah.
I don't want to try to reduce this epic tale, but my impression of GE was part of the problem seemed like a classic case of what Peter Lynch would call diversification, right? Just starting out as one thing and diversifying, but diversifying into other businesses that eventually became really inappropriate to be involved in. Valid point? No. Agree, disagree?
I think the way I think about it after completing my autopsy, and this is sort of a truism, and it's not like a huge revelation, but it really is kind of meaningful and obvious if you think about it, is the importance of the CEO selection. And, in a few minutes, I'm going to talk about this some more, but when I first met Jack Welch, the first thing out of his mouth, even before I sat down, was that he had made a big mistake in selecting his successor. And he said it to me sort of on the record, and repeatedly, and it was basically the first time he admitted to anybody on the record, or certainly any journalist, I'm sure he talked about it with lots of other people, but that he had, screwed up the choice of Jeff Immelt as his successor. So the truth is that Jack made a lot of mistakes as the CEO of GE, but he figured out a way to overcome them. And the bottom line is pretty clear that it was a big success. He took the company from a market value of $12 billion to a market value of over $650 billion. So from 12 billion to 650 billion, making it the most valuable company in the world, as we talked about, and the most respected company. And he was like the manager of the century, right? He made mistakes. He wasn't a saint by any stretch of the imagination. Probably wouldn't have lasted the 20 years he has lasted in our current, Me Too era, because he misbehaved a lot. But I think, and he chose Jeff Immelt as his successor, which is, of course, the most important decision a CEO makes is choosing his or her successor. And so he blew that decision, which is shocking.
Yeah.
And, Jeff Immelt, of course, on paper was outstanding. I mean, went to Dartmouth, went to Harvard Business School. His father worked for GE in the aircraft engine division for his whole career. He grew up in Cincinnati, where his father worked. His brother is a big-time lawyer in Washington. But he studied marketing at Harvard Business School and not finance. And GE was, half of GE was one of the largest banks in the world.
Yeah.
GE Capital.
Right.
And he didn't understand finance. And so he didn't understand the risks that were buried inside of GE Capital, or the way GE Capital financed itself and the way GE financed itself, which is, again, the same mistake. Is what I find so fascinating. And nobody ever thinks of this in terms of GE, but I mean, the things that brought Bear Stearns down, and the things that brought Merrill Lynch down, and the things that brought Lehman Brothers down are basically the same things that brought GE down. Because half of GE was GE Capital, which of course Jack Welch had built up, but at least understood and knew how to manage. And Jeff, I think, pretended to understand what GE Capital was all about, but didn't really understand it. So when, the shit hit the fan in 2008, he went into panic mode in ways that nobody really understood until, I sort of dug all this up, and it's in the book. Needed, went hat in hand to Hank Paulson, the Treasury Secretary, and Sheila Bair, the head of the FDIC, to get bailed out, essentially, even though GE wasn't part of the TARP, but GE availed itself, had no choice but to avail itself of many of the lines of credit that other financial institutions, availed themselves of. And, then GE became, as a result of that, they became a SIFI, what was known as a structurally, important financial institution. Right. I think that's the phrase. Yeah. And Jeff Immelt hated being a SIFI. Not only did it bring, the intense oversight from the Federal Reserve and much more regulation, but, $2 billion more of costs, and they just weren't used to it. And the Fed and the regulators were starting to question what they were doing on the industrial side of the business. So Jeff Immelt decided to get rid of GE Capital, and I think that was a big mistake. I worked at GE Capital after I got out of business school, financing leverage buyouts, and I worked for the chief credit officer at GE Capital for a year. And Jack Welch and I talked about this. What industry did the best after the financial crisis, ironically? Well, one of the industries that did the best after the financial crisis was the financial services industry, Wall Street, because it lost, Wall Street lost Bear Stearns as a competitor, lost Lehman Brothers as a competitor. Merrill Lynch was subsumed into B of A. Morgan Stanley almost went down the tubes, but was rescued by the Japanese. Goldman was rescued by Warren Buffett, who also rescued GE. And the Fed reduced interest rates to zero for a long time, as we know. So it was pretty easy to make money from money. And these banks with less competition and incredibly low cost of capital, gushing money. I mean, last year, JP Morgan Chase made $40 billion of net income. And basically, Jamie Dimon has told me that 36 of that 40 billion is kind of guaranteed every year. So it's the variable is 4 billion, depending on what our traders do or our investment bankers do or whatever. I mean, that's a pretty nice franchise to have. That's why, JP Morgan Chase, was a 300 or 400 billion dollar market value company. GE gets out of GE Capital, which was 50% of its profits, and has nothing to replace it with. The GE's market cap now is like 70 billion, and it's going to be divided into three pieces. So I think that's like an incredibly bad decision, even if you didn't like it. And I know Jeff, because I talked to him about it, he said, I didn't like being a SIFI. It was, we didn't have our competitive advantage anymore. Our cost of capital was now higher because we weren't AAA anymore. Yeah, okay. So what? JP Morgan Chase isn't AAA. Other banks aren't AAA.
That's what he told you. That's the rationale.
Yeah, he didn't like it. And it was expensive, and they were encroaching into his territory and starting to tell him what he could do on the industrial side of the business. And they didn't have the competitive advantage that they used to have. They had an absurd competitive advantage because they had a AAA credit rating. I mean, their cost of capital was just above treasuries. So, they arbitraged that, and Jack loved that. He saw the arbitrage opportunity. So things got a little tougher, but, the financial services industry was an incredible business after the financial crisis. He sort of stuck with it.
And he let it go.
He let not only he broadcast that he was selling it, so that means like the Blackstones of the world picked his pocket. So, decisions like that.
Wow. Okay, so that's a big one considering what was lost.
It didn't have to be either.
Yeah. Is there another big one that comes to mind?
Oh, sure. There are a lot.
Yeah, I'm sure.
It didn't happen.
Yeah.
It took a lot of big ones. Jeff also didn't like. I mean, Jack bought RCA in 1986 for like $6.4 billion, which was the largest M&A deal to that time. That was front page news. And of course, RCA owned NBC. Jack loved NBC. He sold off lots of parts of RCA. The RCA deal is like one of the best deals in American corporate history in terms of GE's acquisition of it. He ended up, getting out of GE's RCA's television manufacturing business, which they couldn't compete well against the Japanese. He swapped it with a company in France for their medical equipment business, which has become the basis of GE's very successful, healthcare medical equipment business, which is about to be spun off in January. He had NBC. He built it up. He created CNBC. He created MSNBC. Gave birth to David Zaslav, who's now the head of Warner Brothers Discovery. Jeff actually, to his credit, bought Universal and made it NBC Universal, or asked some of the assets of Universal, but he didn't like the business, the way Jack loved going on CNBC. And in the financial crisis, in addition to GE Capital almost filing for bankruptcy twice, and which nobody realizes, going hat in hand to Hank Paulson to get a bailout and Sheila Bair, having Warren Buffett come in and buying, billions of dollars of equity and then selling more equity after he said he wouldn't. He then decided, in March of 2009, GE stock was trading at like $6.66 for some. I remember that because sign of the devil. And Keith Sharon, the CFO, went on CNBC to sort of defend the stock, and he did a good job. But at the same time that Jeff was on CNBC, that Keith was on CNBC defending the stock, Jeff was giving a talk at a JP Morgan Chase conference, and had basically made the decision to sell NBCU. And instead of auctioning off NBCU, well, you've got an incredible asset like NBC Universal. You should run an auction. He didn't. He just called up Brian Roberts at Comcast and said, do you want to do a deal? Which is something they'd talked about off and on for, 6 months. And he sold it to him in pieces, and he sold it to him for about $30 billion in total. And it's not worth quite as much today as it was a few years ago before the pandemic. But at one point, NBC Universal was worth $100 billion. So Jeff sells it, in 2009, 2010, for $30 billion, and Comcast got the steal of the century. So that's another example. He overpaid for Alstom. He overpaid for Amersham. He got out of the financial services business. He brought in Trion, the hedge fund, and he thought they would be friendly. And then he promised that he was going to make $2 a share, and he never got there. And, the hedge fund blew him up.
Why did he hire him in the first place? Now I want to know what Welch says. Why did he make this mistake? Why did he choose him?
Well, I tell that story too. He made that mistake because Jack didn't like the way he was selected. So Jack, and he didn't want to do his selection process the same way he was selected. He was selected. He was forced to come to Fairfield, Connecticut, along with the 4 other contenders for the job for 2 years before he was selected in 1980. And he didn't like that. He thought it was like a beauty contest. He thought he was everyone was sort of competing and looking at each other, and he just felt very uncomfortable with that. So when it was his turn to do it 20 years later, he decided to keep the 3 finalists out in the businesses they were running. So Jim McNerney was in Cincinnati running the aircraft engine business. Robert Nardelli, I think, was in Schenectady running the power business. And Jeff Immelt was in Milwaukee or Chicago, wherever he was, running the healthcare equipment business. So he kept them out there. He didn't bring them into Fairfield. They would come to Fairfield because they were on the board of GE Capital, or to make reports on a monthly or quarterly basis. And of course, they knew they were finalists for the job. So what did they do? They were in total suck-up mode the entire time. So who's the best politician at that point? And the best politician was Jeff Immelt, because the guy was at a central casting, football player, very confident Harvard Business School guy, and Jack just fell for it.
Wow. That is something. I can't wait to read this thing. We've actually been talking away here, and we're getting to the end of our time already. So I'd like to ask you my final question, which is the same for every guest. You have answered it once before. And it's just, if you could leave our listener with one thought today about anything at all, what would it be?
Well, given your listeners are sort of investor focused, I think I have to return to this idea of invest in companies that have the right CEO in the spot, who not only are good managers, and inspire the troops to pull the boat all in the same direction, but who really understand all aspects of their business, and aren't sort of better at, and I don't mean this derogatorily, aren't better at kind of bullshitting than they are at making considered decisions after listening to all the inputs and taking the advice of the people in the field who really know what's going on. And I know that's hard for an investor to do, but because there are a lot of powers aligned against that, because research analysts write their reports, or then the CEO goes on CNBC and makes their spins away, and then the media helps them spin away. So it's hard for investors, and it's hard to do that research. So if you can't do it yourself, you should have an investment advisor who can do that work for you and who takes that kind of responsibility seriously, and have them be a fiduciary for you. And I'm not just saying that because that may be something you guys do. I really believe that that there's something to that.
All right, great answer, and thanks for being here, Bill. I really am super excited based on what you've told me. I mean, it's this much, but I can't wait to dig into this book.
Appreciate it.
You bet. And just for the listener, one more time, the book is called Power Failure, The Rise and Fall of an American Icon by William D. Cohan. All right. We will hopefully talk to you again. I'm going to finish some of your books, and then we're going to have you back.
You just let me know anytime you like.
All right. One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's nightmare winter. Woo! You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, and the U.S., plus 3 large properties in Europe. And I've been to one of them. It's gorgeous, gorgeous chateau. And I've known Bill for many, many years. He hired me into this business. And he says we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. And he's made 3 similar predictions in his 50-plus year career. And each time it proved to be exactly right, although he was mocked each and every time. And I remember all of them. This is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report that we've put together called America's Nightmare Winter. Get the facts yourself. Go to www.nightmarewinterscenario.com to get your free copy of this report. Even if he's only partially right, it'll dramatically affect you and your money. So again, go to www.nightmarewinterscenario for this free report. Well, I have to say, I'm biased here because William Cohan is one of my favorite all-time financial authors. The way that he digs super deep into any topic, he talks to everybody, and of course he has the experience from his career on Wall Street behind him, so he understands what's happening, and then he just digs and digs and digs until he finds out exactly what happened, what was said, who said it, when they said it, everything. So it winds up reading like this. It's almost like the script of some epic, film, or like the greatest Netflix series on that particular topic. And I can't wait to dig into, the new book on GE, Power Failure. I'm moving through his books. They take a little time. They're longer than, like a Michael Lewis book or something by, 100 or so pages usually, but it's worth it. Like William said during the interview, once you get in there, you don't want to get out. It's that kind of a read. You love being in that world. That's the kind of picture he paints. So anytime that I get a chance to talk to him, I'm going to take it. And I love talking with him. So that is another interview, and that is another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. If you have a guest you want us to interview, drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.